Hello friends, welcome to the Warrior series of BFM. In Warrior series we are covering the case studies plus MCQs. Case studies related to numericals as well as theory. Same thing about MCQs. Today I will be covering the important numericals, very important, that also case studies. So watch the video completely, share it with your friends, like the videos, subscribe to the channel, click on the bell icon. Let's start. Very important, very difficult ones. These are all repeated in the exams. Okay, all of them are PYQs. So let's start. Euro 1 equals to USD 2.3180, 3190. Forward differentials are 1 month is 1518, 2 month is 3037, 3 month is 4149. Calculate the 3 month offer rate. See what is asked, offer rate. Kindly note, offer rate means what? Offer rate means buy offer, bid offer, bid offer. It's like this. So this is sale. Offer means sale. So sale is always on the right side. This is always sale. This is always buy. Purchase, bid or buy. So you want 3 month offer rate, 3 month. Spot is given. This is called a spot. Spot. And these are all forward differentials. Now, if you check the forward differentials, these are all in premium or discount. Type in the comment section, everyone. Is this in premium or discount? I want the answer. Premium or discount? Yeah. Premium, correct. Premium. Okay, because the right side is bigger. Whenever you have right side bigger, kindly note, it's a premium. Okay. Whenever you have left side bigger, this side, then it's a discount. Premium means what? Premium is add. So you'll have to plus. Anything related to TT margin is given? Nothing. Generally, see, in any numericals, you have to check 3 points. First is buy or sell. Buy or sell. Second is forward margin. Forward margin. And third one is TT margin. These 3 things you have to check always in any numerical, any Forex numerical, you have to check these 3 things. So first is sell, so buy is gone, sell. Forward margin, you know, premium, so you'll have to add. TT margin not given, so 0. This is NA, not applicable. Okay, so let's solve this. See, I've already solved it over here. What is given? Forward differential, 3 month offer rate you have to find out. So what is the spot rate given? See, 3 month forward rate is always what? Spot plus premium. So spot is given as 2.3190 plus premium for 3 months now. 3 months you want it. So 40 and 49. So 49 you will be taking, right? 0.4900. So add this 2.3190 plus 0.49. So it will be 2.8090. 2.8090. So this is your final rate, over. This is over. But what have I done? In the numerical, TT margin was not given. I have given it personally. Now you will have to solve. See, if the numerical was this much only, this much, then your answer is very simple. 3190 plus 0.4900. Simple. Your answer is over. But if you add TT margin to this TT margin, then the problem becomes difficult. Then in TT margin, what you have to do? 0.15% it's given. So 0.15 upon 100 into 2.8090. So if you multiply this, you will get it as 0.0042. So what will you do now? Will you add or subtract? For TT margin, always remember, whenever you are selling, you will be adding it. Selling means offer. So you will be adding it. So here you will be adding 2.8090 plus 0.0042. So it will be 2.8132. 2.8132. Got it? So look at this. Buy or sell, forward margin 3 months. TT margin I have added separately. Okay. Now here is a separate homework for you. You can try it yourself. 1513, 2 months is 4037 and 3 months is 1549. Try the same one. You can try it now also if you want. Try it. Chalo. Let's see. Try this. 3 months I want now. For this question, this. 3 months. So it is 0.49 minus. So it will be about 1.8290. But is the problem over here? No. The problem is still there. Because TT margin I have given this. So add this TT margin, subtract it now. Because you are doing what? No, add only. Because it's a sale transaction. Right? So sale means add only. So 1.8290 into 0.15 upon 100. Do it. Everyone do it. Into 0.15 upon 100. What is the answer? I am doing it for the second one now. This one. Huh? This one. So what is the answer? You are getting, type in the comment section. Type in the comment section 1.8290. 1.8290 into, what is it? 0.15 upon 100. 0.0015. So 0.0027. So this TT margin over here becomes, TT is 0.0027. So this you will have to add it now. Add this plus 1.8290. 829. So the answer becomes 1.8317. Answer is 1.8317. This is for the second problem. Okay, not the first one. First one was over. This is the second one I started. Okay. So everyone got this answer? 1.8317. Has everyone got the answer? 1.8317. Type in the comment section. Everyone fast. In the comment section, I want to see every answer. Are you getting it? This is for the second problem. Okay. When you have this is what? Discount 1513. It's a discount part. Discount means minus. TT margin will be subtracted over here. See this, we have subtracted. Done. Move. Next. A bank purchases export bill of USD 50,000 at rupees 42.66, which was dishonored for non-payment. How much amount will be recovered from the exporter if the spot rate is 42.2030? Exchange margin is 0.15%. See, purchased an export bill. So when you purchase an export bill, it's basically a buy transaction. So you have done a purchase over here, buy. So now what you have to do? You have to non-payment, dishonored. So it will be reverse. Reverse means what? You will have to do the sale transaction. So now what you will do? Now you will be doing sale. Because first you had done the buy. This was buy. Now you will be doing the sale. So sale means what? What is the rate you will be taking? 42.30, right side. Isn't it? So this rate you will be taking plus what is it given? Say this. This buy was done at 42.66. Now today you have to do with no money. No money means it is dishonored for any reason, for non-payment. So now you have to do the sale transaction. So 42.30. Say this, 30. But TT margin is there. So 42.30 into 0.15 upon 100. So what are you getting? If you do this, 42.30 into 0.15 upon 100. I think so this is the answer. 0.0634. Are you getting it? Everyone try this. See, you have to try it. You be true to yourself. Don't try to influence others. Try to influence yourself. Try to be true to yourself. Because in exam, it is directly a litmus test. Isn't it? So, 0.0634. Are you getting it? 0.0634. And this is what sale. You have to do sale. Sale means what? Add. Isn't it? So, you will be adding it now. Now you tell me. 42.3 and zeros. All the zeros you will write it. 42.3 and some 2 zeros. Plus 0.0634. So, what will you do? Plus or minus? Now you tell me. Will you do plus or will you do minus over here? It's a sale transaction. What are you doing? You had earlier done buy. So now you are doing sale. So sale means add. So do it. So the answer becomes 42.30 blah 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 0.0634. So 42.363. Yeah. And 4 also you can write it. 363. Let it be. So this is your answer. 42.363. So this is the rate to be applied. But now the question is what? How much amount will be recovered? Question is not about rates. Now recovery. So multiply this 42.363 into This, what was the amount? 50,000 USD. Multiply this. So 50,000 into 42.363. So you'll get it as what? 21,18,150. Check it. Everyone check this. I'll wait for 1 minute. Give me the answer. Are you getting the same answer? Everyone must get this rate 42.363. Everyone. Are you getting it? Fast. Everyone fast. Yeah? Clear? Be true to yourself. Don't try to do something. Yes sir, got it. No. Let you be late. Rewind this video again. What's the problem? Right? So multiply 21,18,150. Got it? So this is the amount. This is, see, you are doing a sale now. You have sold $1. You will get the money from this buyer, this much amount. So this is the amount, 21,18,150. Right? Got it? So now, this is the amount of recovery. Got it? Let us borrow from one center and lend to next numerical. Huh? Let us borrow from one center and lend at other center. This is arbitrage problem. This is known as arbitrage. Let us borrow at one center and lend at another center at higher rate. In USA, the rate of interest is 6.5%, whereas in France, the ROI is 3%. For euro, we will borrow from France and lend to USA. 1 euro equals to 1.5 USD. Now you have to find out the arbitrage. What you will be earning or what will you be losing? Will you earn or will you lose? Simple question. Now everyone amongst you tell me, will you earn or will you lose? Just by looking at the problem, logically, what do you think? If you buy from USA, no, you buy from France and you lend it at USA. So will you earn or will you lose? What do you think? Simple, you should earn, isn't it? You should earn. Why? Because rate of interest in France is 3% and in USA it's 6.5. So I take a loan from France at 3%, put a FD in USA at 6.5%. I earn. Isn't it? Got it? So this one, look at this difference. 6.5% minus 3%, 3.5%. This is a difference. So this much extra I will be getting at any cost. Other commissions and everything is not mentioned. So leave it. If they mention some commission, then you'll have to add and subtract it. So here nothing is mentioned, so leave it. Directly 3.5% would be a net profit. Now multiply to the amounts. Look at this. PNR upon 100. Right? Simple interest formula. PNR is what? See, 1 euro equals to 1.5 USD. So 1.5 is P into 1 year N into R is what? 3.5%. This difference upon 100. So this much I will be gaining. So 1.5 into 1 into 3.5 upon 100. Everyone try this. Try this everyone. What are you getting? 0.0525. This much would be my income per euro. This much would be my income per euro. Per euro for 1 year. This much would be the gain of mine, isn't it? Simple interest. Right? So this much I will be earning as an interest, means extra interest, extra amount. 0.0525 per euro. But is it given how many euros? No. If they give you, let's say 1000 euros, so multiply it with 1000. Right? If they give you 1000, then multiply it with 1000. If they don't give you anything, leave it. So here it's over. Okay? This is how you will be solving. You can solve it in other way also. Some of you might be getting confused over here. How this 3.5 I have got it. So you can solve it in different way also. Means for explanation I will give you. How will you solve? See this. I'll take it like this. Let's take it. France and USA. Okay, two countries will take it separately. What is it? I am getting from 3%. Let's say 100 euro. Okay, 100 or 1 euro. Why 100? Take 1 euro. Okay, so 3% and what? 6.5%. So from here I'll borrow. So borrow means what? 1 euro. Okay? 1 euro I'll borrow. So 1 euro I'll borrow means what? Let's take it 100. That's simple, isn't it? 100 euro. 100, because 100 is calculation is simpler. So 100 euro I'll borrow at 3%. So how much will I pay at the end? So minus 3 euro. This much I'll pay at the end, interest. Right? Interest. Let me draw the line over here. Because some of you have got confused. So minus 3 euro at the year end. What will I do? I'll take this 100 euro and convert it to dollars. So this will be what? 100 euro and 1.5. So $150. So $150 I'll be having. This dollar, what will I do? I'll put it as a FD. So how much will I earn? 150 into 6.5%. Do it, everyone. 150 into 6.5%, isn't it? So what are you getting? 150 into 0.065, right? So you're getting 9.75. Are you getting it, everyone? 9.75. Are you getting it? 9.75. See, dollar 9.75. I am getting plus. This is the addition because this is the FD. So I am getting $9.75 plus. And here I am getting 3 euro minus. So convert this back to euro. Divided by 1.5. So 9.75 divided by 1.5. So it is 6.5. See, I am getting 6.5 over here. Euro. So net what is happening? What is happening net? 6.5 I am getting in 1 year. I am earning 6.5 and I am giving 3. Right? So net is what? 3.5 euro is a plus to me on 100. 3.5 euro is a plus to me on 100. This is what I am gaining. This is called as arbitrage. Okay? This is called as arbitrage. In a year I am gaining this much on 100 euro. Okay? Now it depends on what euros. Right? So net I am gaining what? 3.5 euro. Got it, everyone? PCR Bank has granted term loan of 2 crores to a reputed corporate client for 6 years at R plus 2. R means what? Repo. Repo plus 2. The above said loan is funded with a low interest FD of rupees 2 crores at 7%, whose maturity is 4 years. The loan is carrying a floating rate. Obviously, loan is carrying a floating rate, whereas FD is carrying a fixed rate. Even this line wouldn't have been given, then also it's okay. See, what is it? Understand the case first. You have given a loan. Loan rate is what? R plus 2. Repo plus 2. Now that is floating. Tomorrow if repo changes, your rate will change. So this leg is called as floating. Float. Okay, and what is this? The above side loan is funded by a bank with a low interest FD of 2 crores. Amount is same. See this 2 and 2. But here the rate of interest is 7%, fixed. So this leg is fixed. Right? So this is called as what? When one leg is fixed, other leg is floating. It's called as what? Type in the comment section. I've told you so many times. In the paid classes also, in the YT also. What is it called as? Yeah, it's called as swapping. Right? Financial swap. So now look at the questions. Fixed rate of interest, everything you have got the case. Now look at the question. If the rate of interest is reduced on both loan and FD during first 4 years, which type of risk the bank is exposed to? So both the rate of interest is reduced on both loan and FD. So funding risk, embedded option risk or basis risk. Bank will be exposed to which type of risk? Yes, both are reducing. Loan also reducing, FD also reducing. But there is a problem now. What is the problem? FD is reducing by fixed rate from 7. Loan is reducing based on repo. So their magnitudes are different. That is called as when the change in proportion of FD and loan rates is different. It's called as which type of risk? Basis risk. Okay, this is called as basis risk. Got it, everyone? This is basis risk. Clear? Next one. Same problem. Rate of interest at the end of 4 years may be different on both FDs or different on FDs. Okay. So this is called as what? Reinvestment embedded option, basis risk. See, rate of interest at the end of 4 years may be different on FD. So now look at this. The FD over here on maturity, you may not get the same rate of FD. At that time, you'll have to give it at a higher, take at a higher rate also, or you may get a lower rate also. So what is that called as? That is called as, yes, this one. Reinvestment embedded basis. Called as basis risk. Basis risk means, sorry, this is not basis. Hold on. This is basically what are you doing? Reinvestment. This is a part of reinvestment risk because you don't know at what rate will you be getting the new FD. You might get it at a higher rate or at a lower rate. So that is reinvestment risk. Okay? There is a possibility that a company will prepay the loan. Means this company to whom you have given the loan, that loan will be prepaid. The company says, see, I don't want your money, take it back. Or the depositor may withdraw deposit prematurely. So now depositor might come to you, say, take this FD, give me my amount back. What is that called as? Which type of risk is the bank exposed to? Reinvestment, embedded option, basis risk, gap risk or mismatch risk? Yeah, what is it called as, everyone? What is it called as? Yes, fast. It is called as? What is it? When there is a possibility of prepayment of loan or premature withdrawal, it's called as embedded option risk. Correct? It's embedded option. Embedded option risk. Got it? Everyone clear? With quarterly repayment of loan, the repayment amount has to be deployed by the bank elsewhere at different rate of interest. Due to this, the bank is exposed to, understand this. With quarterly payment of loan means the customer is paying you quarterly. It's not a monthly loan, quarterly. Allowed, it's allowed. Quarterly repayment is allowed in banks, okay, of loans. So this repayment amount has to be deployed, means the amount which comes to the bank has to put it somewhere. So what is that called as? Reinvestment, embedded option, basis risk, gap or mismatch risk. Yes? What type of risk is the bank facing? Means I am getting the interest, but what to do with that interest? I don't have, means the interest which I am earning, I have to invest it somewhere. So it's a part of reinvestment. Okay, again reinvestment risk. Okay, so these types of case studies are very important. Okay. So now, before going, everyone, kindly join the Adda 24/7 crash courses immediately. Okay, immediately I'll tell you. Why? Because the crash courses have just started. Okay, they have just started. Always purchase the courses by downloading the app first. Download the app, because in the app you will be getting 1% extra discount. Why don't use that? See this, the crash course in English. Join this. E-books, mock tests, online live classes, recorded sessions, everything you are getting. Okay? Recorded sessions are also available. So if you miss out someday, you can get back. Mock test, chapter wise, full length, both same as that of the exam. You are as if giving the exam only. And remember the code Y432. Y432. Okay? It will give you 79% discount plus 1% extra through the app. So 80% net you are getting. 80% discount. Huge it is. Join it ASAP. Okay? Bye everyone.